So I want to talk to my therapists who are in their second year or maybe even beyond of private practice, because this is often the year that things start to feel a little bit different, right? You're a little bit busier, probably making a little bit more money, and your practice feels like you're gaining some traction, right? All great, amazing things. But this is also the year that many therapists make the exact same tax mistake and they don't even realize it. I am Alan Pruitt. I am the therapist CPA, and this channel is for therapists in private practice who want fewer tax surprises and more clarity around their money without any overwhelm, shame, or anxiety. This is day 10 of our 30 days to financial clarity for therapists. And out of all the probably hundreds at this point of therapists that we have coached, I have learned the number one biggest mistake therapists make in their second year. You want to know what that is? They do not adjust their tax plan as their income grows. Your tax plan is something that is always going to be evolving, especially as revenue grows, as you get more successful, as you get busier. So if you are not doing that, then you're a little bit behind the eight ball. That's okay. We can catch up. But I just need you to be cognizant and realize where you're at. Because here's the thing. In your first year, income is often inconsistent. You might not owe much at all in taxes. You might even get a small refund because maybe if you started at the end of the year, maybe you had some startup business expenses and whatnot. And so, hey, that might have helped you out overall. And hey, you might have gotten a refund, right? But I tell clients this: when you become a business owner, think about this. The race is not to receive a tax refund anymore because you have hacked the game. You are playing the IRS game because they want you to be an entrepreneur or investor. Your game now is a race to zero because you're going to make more money than you did before. However, we want you to owe the least amount of taxes. So your race is to zero, not to a big refund. Your race is to zero. And so it's easy to assume that this must be, how it works. Like, hey, year one, boom, great. Hey, year two comes along, exact same thing. But guess what? Things have changed. You're more established now. You're seeing more clients. Maybe your rates have increased. You're getting more referrals in. Hey, maybe you've been talking with the insurance company and you've got them to up that reimbursement rate. And so then all of a sudden, when you come to somebody like the therapist CPA and we're doing your taxes, as I talked about earlier in our series of financial clarity, I had a client who came to us and she was in her second year, $15,000 tax bill. This is the mistake that she made, not intentional, but this is what happens. And so I do not want you to make that mistake because that feels shocking because taxes in a business, they are not static. That changes as your income changes. So what worked in year one, most times does not work in year two. And therefore, if you aren't adjusting this, if you're not setting aside money for taxes, I talked about already, I need you to have those two different accounts. If you're not setting aside money for quarterly payments, or if your overall strategy isn't proactive and it's reactive, then that's how you can unfortunately end up in this situation. But you're smarter than that because you're here watching this. So you're not going to be that person. So, but even if you did, guess what? This doesn't mean that you did anything wrong. It just means your business has evolved and changed, but your tax approach didn't. Proactive tax planning is about checking in as things come. When income and your revenue increases, it's time to ask, hey, does the amount of quarterly taxes I'm paying now make sense? Am I paying quarterly taxes at all? Am I setting aside money? Are there tax strategies that I should now be considering since I have more money, right? These are forward-looking conversations that I need you to have because these aren't the conversations you want to have in April. Because guess what? As I've told you guys before, there are two tax seasons. There is tax paying season, January through April, And then there is tax saving season, where you're being proactive from May throughout the end of the year to make sure that that next tax bill is a good one. And so I have your one simple action, your one homework item I need you to take away today is ask yourself this. Is your income higher this year than it was last year? And if it is, did you adjust anything because your income is higher? If your answer is no, no worries, not a failure. It's just a sign that you probably need a new tax plan. So think about that. Over the rest of the week, we'll be, continuing on to talk about how planning, being proactive, evolves as your practice grows. So your money feels more predictable, less stressful. And I hope this was helpful for you. Please subscribe, like, share this with a therapist friend of yours. And if you want to keep building on this, please click the link and watch the rest of our 30 days to financial clarity for therapists. That is linked below. Thanks, y'all. Be blessed. Peace. Mind on the numbers, heart with the care. If I don't